Bloomberg Audio Studios. Podcasts, radio, news. Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, China Tech on deck. We take a look at the latest from Beijing's tech sector, from earnings to chip developments and US restrictions, plus more. Meanwhile, AI spending is under scrutiny with Dell and Marvell falling after their earnings. And we hear about the SEC's vision for crypto in the United States with Commissioner Mark Ueda later this hour. But first, we check in on these markets, which are broadly under pressure in the United States, but not so in China. And that's a story of earnings. Look, we're off by 1.3% on the NASDAQ 100. We are still questioning the overall build-out of AI infrastructure, its lumpiness, and what we heard from NVIDIA, but we spill into what it means for AI servers, for Dell, and indeed Marvell. But I'm looking at the Golden Dragon Index. This is, of course, a reflection of big tech in China, traded here in the United States, a lot of them ADRs. Well, thanks to Alibaba's numbers, we're higher by 1.5%. Baidu as well, doing well, as we understand that their tech stack is continuing to flourish as China really looks to find domestic competitors, build them themselves, versus being reliant on NVIDIA, for example. Move on and have a look, though, at some of the US numbers that we're getting out at the moment. And I say that on the back of real worries for NVIDIA, off by 3.5% today. Yes, their earnings we still digest, but actually news reports that Alibaba is looking at its own AI chips to be made by itself, by Chinese manufacturing. We've also got the story of Baidu, as I said. Marvell is off by 17% as we see concerns about lumpiness with its own demand. How are we seeing Marvell's technology and ASIC chips not be picked up in this current environment? Dell is off by 8% as AI servers look lumpy, and that's where we go first. Woo Jin Ho can break it all down on the Dell front. Now, actually, they beat and they raised, but when you dig into the detail, AI server bookings were less than the previous quarter.
Yeah, well, if we think about the timing of these deals, Caroline, there was one big deal that went in, and it's unclear who it is, but it's probably one of the big neo-cloud vendors, whether it's CoreWeave or XAI. So it is going to be sequentially down, but if we think about it from a second half to first half basis, it's $10 billion even second half versus first half. So, things are going well for Dell in terms of these deals.
Things are going well, but many had perhaps baked in just numbers up and to the right in terms of the market valuation. What is it that investors need to hear in terms of clarity on margins in particular? Because there is a bit of a fierce competition between Dell, Supermicro and others.
Yeah, and that's where the issue is, right? I've always said that being a leader in AI servers is a double-edged sword. What you get in sales, you're not getting it in margins, right? It's a high-calorie, low-muscle-building type of business. And let me give you an example here. The $1.2 billion AI server beat only equated to a 2-cent beat in EPS, right? And that's going to flow through with maybe modest improvement, even with the additional $5 billion in AI sales in the second half.
Woo Jin Ho, it's been a very busy week for you. Thanks so much for joining, Senior Analyst for Bloomberg Intelligence. Look, let's broaden out, because elsewhere in the AI race, the US Commerce Department has just said it is removing the ability for Samsung, SK Hynix, Intel to move some goods from China without a license, dealing yet another blow to China's access to advanced chip-making know-how. For more, Bloomberg Executive Editor Mike Shepard breaks it all down. Basically, this is revoking waivers that they previously had, to bring in a chip equipment to the country? Break down exactly what this means.
Yeah, that's right, Carol. The companies have received waivers from the Biden administration back in 2023, allowing them under these agreements to bring in equipment to China for their massive chip-making facilities. And most of what was produced there, Carol, were memory chips. And that's critical, of course, for SK Hynix and for Samsung in particular in this case. Now, it's under what's called a validated end-user agreement. And that essentially is sort of like your pass. It's almost like you get a free pass based on this agreement and understanding and discussions with the government that is being revoked now. And the Commerce Department is saying in a statement accompanying the notice that was posted to the Federal Register this morning that what they're trying to do is deny to foreign chip manufacturers a benefit that really wasn't extended to American chip manufacturers. And you mentioned Intel there. We have since learned that Intel has sold that portion of its China operations to SK Hynix. So it really applies only to the two South Korean companies in this case.
What's interesting is in the statement, as you've been surmising for us, they said they do not want to allow companies to expand capacity or upgrade technology at manufacturing facilities in China. I'm noting that ASML shares, for example, are down, and they seem to accelerate their losses on the back of this news, a big chip equipment maker. All of this, though, is about the overarching competition that the US feels with China.
It is about the competition with China. And then there also is some push and pull on trade as well with other trading partners. And when you think about South Korea, Caro, the president of South Korea was just in Washington earlier this week to meet with Donald Trump. And the whole question about the trade agreement and where tariffs would fall, just like with China, the questions about export controls and how semiconductor tariffs that are still to come might affect these two industrial champions in South Korea. When you think of Samsung and you think of SK Hynix, they are really at the vanguard of the economy there. And that had to have come up in some context during those discussions with the U.S. administration. And we have heard since from the South Korean Ministry of Trade, they say that they were warned ahead of time, according to Yonhap, the news agency in South Korea. They were warned ahead of time by U.S. officials that this would be coming down the road. Now, it's interesting if you parse the Commerce Department statement, they say that they will not be granting licenses to advance technology in China or upgrade or expand capacity, but it doesn't necessarily preclude maintenance or replacing existing equipment without carrying it to a new level. So it'll be interesting to see how this affects, as you mentioned, ASML, but also Tokyo Electron, an ASML competitor in this space of chip making equipment. And the impact, of course, also on the broader trade relationship, likewise, will be worth watching as well, Caro.
Perfect context, as always. Mike Shepard, happy weekend. We thank you. Talking of China and the chip innovation being forced there in many ways, Huawei just posted its first half profit, getting back into the black after DeepSeek helped to ignite a wave of AI development across the country. Now, Huawei has expanded into new areas, including electric vehicles, and has restructured its cloud unit to focus more resources on AI and computing. That's according to Chinese media reports. Coming up, we stick with China. Alibaba reports a surge in revenue, you guessed it, from China's AI boom. But will it last? And let's look elsewhere in China. BYD, we're just talking about how Huawei is getting into the world of EVs. BYD currently off by 7% now. It posts a shock profit drop as the price war is really hitting Chinese EV makers. From New York, this is Bloomberg Tech. A lot of news coming out of Asia Tech today, including China's warning against excess competition in the AI race. Meanwhile, AI chip darling Cambricon has warned to its own investors of the recent run-up in its stock. All of this as Alibaba, the tech giant and one of the biggest names in global e-commerce, reported earnings that saw a surge in revenue, but it stemmed from China's AI boom. Bloomberg's executive editor of global technology, Peter Elstrom, can help weave this narrative for us. Just starting with Alibaba, it did incredibly well, but it seems to be on the back of AI demand rather than e-commerce to a certain extent.
Yeah, it was a pretty unusual earnings report. We just got done getting the numbers. They actually missed on both revenue and on profit. In that case, you'd kind of expect their shares to be going down, not up. But what investors saw in this that was pretty positive is they saw the increase in AI demand and especially cloud services at Alibaba. So Alibaba said that AI-related demand increased by triple digits. Their cloud unit overall increased 26%. That was quite positive for them. And then on the earnings call, call, Eddie Wu, the CEO, talked in quite a bit of detail about how their customers are using AI and some of the applications. They talked about automakers, for example, multimedia companies being able to develop these very targeted, customized AI models that they can use in their expansion. He also talked about agentic AI and the move from chatbots to agentic AI and how that puts even more pressure on the infrastructure, which is exactly what Alibaba does, much like Amazon, and that has resulted in a lot of demand for them. So it sounds very promising on that front. Just as we're talking, I see the shares are going up even more.
Yeah, 3 months, we're up 14%, we're up 8% on the day, Peter. And like Amazon, there are reports coming from the Wall Street Journal that Alibaba's doubling down on making its own chips, customized chips, actually looking for Chinese manufacturing of those chips. At the same time, Cambricon, which is seen as market valuation double in just a month alone, is warning its investors to hold steady on some of the rumors swirling around how much China is leaning in to the domestic chip arena. Peter, can you break that down for us? How much is China worried about the sudden enthusiasm around domestic chips?
Yeah, there's a lot going on in this space. Maybe a good way to think about it is that Beijing is very determined to be able to get their own capabilities in AI and by extension in semiconductors in particular. So Huawei is really their leader in designing the kinds of chips that would compete with NVIDIA in particular. They have their Ascend chips. They have been used and they're not as good as NVIDIA's. Customers there still would like to be able to get access to NVIDIA chips. Cambricon is another company that's designing chips for AI that are quite good. They're really focused on inferencing, though, running the models, not as much training the models, which is where NVIDIA really excels at this point. And as you mentioned, Alibaba is developing their own chips. It's very similar to Amazon, where they'd like to not pay the premium for the very expensive chips from somebody else if they possibly can. They want to be able to design them and then replace some of the more expensive chips that they maybe would buy from Huawei. In Amazon's case, they're paying premiums to NVIDIA. They want to have some alternatives in-house that'll be a little bit less expensive and also will just loosen their dependence on some of these chip makers, not make them captive to whatever supplies they can get at any moment.
And very much the Chinese government not wanting a repeat of food delivery or of the EV battle that's going on, trying to restrain some of the overcapacity that potentially might get built up. Peter Elstrom, perfect to have you today. Thank you very much indeed. Happy weekend. Let's get back to those Alibaba numbers and bring in Jacob Cook, co-founder and CEO of e-commerce consultancy WPIC Marketing and Technologies. Because Jacob, we really lent into the AI side of the equation with Peter Elstrom, but I really want to understand, what about the e-commerce flavor that we all know and love from Alibaba in many ways? How has that performed for the Chinese domestic audience?
Well, I think there was definitely some bright spots in that report. I mean, we were expecting reasonably good news after the last 6/18, which is the second biggest shopping festival, being up roughly about 15%. But when we look at the overall revenue of the company, I mean, we get rid of the Turkish e-commerce platform and a couple of their sell-offs in the retail space. Their revenue overall was up 10%. So I think that's probably a lot of the really good news that investors are focusing on and why that stock is up so much despite the miss overall.
Yeah, I mean, the miss was in many ways completely digested when you're seeing the stock up more than 11% on the day, Jacob. Give us what your reading is on consumer sentiment, on the desire to be plowing into e-commerce, because many would say it's not great, but you perhaps have different signals.
Yeah, I mean, on the ground, we have seen, we're well past the years of 30% year-over-year growth, but we're talking still 15% growth in 2025 off the largest already e-commerce market in the world. Those are obviously incredibly good numbers for businesses and brands. I mean, the instant commerce too, which I think is also really important. I mean, that's basically since April where attention was put on that now too, and I think that roughly by our calculations, they could be up to 50% market share, really starting to compete with the likes of Meituan and whatever else. So it shows us the consumer's good. Fliggy, the travel platform's been really good for them. And I think that when we look at that restructuring now and being able to get back into north of double-digit growth, really effective strategies on how to compete with PDD, it looks pretty good in terms of their core business, their e-commerce business.
How does a flywheel work? When you think about adding AI and the investment there into all of its other offerings that go direct to consumer?
Well, the AI, especially in terms of product recommendations and overall building a profile, and I think that's actually why the instant commerce was such a big part of this. If you look at how full stack really that product is, or the offering is in China, you've got everything from the C2C, the B2B, all the platforms, all the purchasing is there, including the instant commerce and overnight delivery. They're really gathering just a ton of data, and I think they're going to be a little bit better positioned than the likes of Meituan and some of the others that are focused on the consumer because they're getting so much data. And yeah, there was really good news in terms of what they're doing with the AI models as well.
Jacob, what you do is you advise global brands about getting into Asia, such as China and Japan and the like. So how are global brands accessing a platform like Alibaba at the moment?
Well, they're doing it, they're engaging a lot more. I mean, even, overseas revenue was up, I think, almost 27% as well, too. And that's a lot to do with the investments that have gone into Singapore. I mean, they're selling a lot of AI services to companies, too. And they're also helping to move a lot of products. I mean, their SignNow logistics network is really helping to connect Southeast Asia, too. And to be able to use kind of China as a hub, with their bonded free trade zones of really just dumping your products into that market, in terms of mass and being able to sell all over through the region now. I mean, they also own, one of the largest platforms in Southeast Asia with Lazada too. So it's pretty exciting in terms of what they're building out.
Talking of dumping of products, Jacob, we're about to have a conversation all about de minimis, but I want to ask you about geopolitics. I mean, how has it affected Alibaba and its ability to grow?
Well, Alibaba's probably been the one that's been, there's been a lot of news. It's not just Alibaba, but we saw the Tencent releases a couple weeks, so everybody's growing. Everybody seems to be getting the compute that they need. The data centers are growing really fast, one of the top growing divisions. So it doesn't seem to be affecting the numbers. I mean, this isn't the first time they've gone through tariff increases. There was, the first trade war as well, and they've seemed to come through all of that. It's certainly stronger, and who knows, maybe they would have been growing faster without these, but, it's hard to see, or it's hard to even think that the damage or the let's say headwinds that they're trying to impose with these policies having really any effect. I think what you're going to see now is these restrictions really start to get lifted. There's really no point, and it's hurting U.S. companies, I think, just as much as it was designed to impede the Chinese ones. So I expect more opening up through the rest of the year. Interesting.
So because your expertise is so important here because you're on the ground, you're understanding what's going on there. And from a US perspective, we're seeing limitations to NVIDIA and AMD being able to sell in, having to give 15% away, not getting licenses as quickly as they might like, feeling that they're having to give away the opportunity. Jacob, you're not feeling that that's going to be in long-term standing?
No, I don't. I mean, look at, Qwen 3, the Coder model, and a lot of the other models too, they're keeping up internationally. So the lack of chips and the lack of compute isn't hindering these models. Tencent, released a couple of weeks ago, said the same thing. They have all the chips that they need, and the advances that this has spurred domestically at Huawei and Shanghai Semiconductor have been really strong. So they're not serving, I think, their intended purpose, and there's really no point. The companies don't want these restrictions on anymore, and people want to do more business over there.
But do they even want the chips, Jacob?
That's another good question. I mean, how far are they now? How far are they developed in those 2 years out of necessity? That's a really good question. I mean, we're going to see developments, and we'll find out. I mean, NVIDIA's not doing very well today on this news. It's probably not a very good sign for them. So hopefully those doors open up and they can get into that market ASAP, and that there's still demand, at those price points compared to what's being produced in China.
Jacob Cook, CEO of WPIC Marketing and Technologies, the real expertise in the region. We thank you. Let's stick with, the e-commerce area, because today marks the end of the US de minimis exemption. For nearly a century, we allowed low-value goods, recently up to $800 worth in value, to enter the country duty-free. The change is expected to have a wide impact. So let's unpack with Josh Ketter. He's global CEO of Spreetail. It's an e-commerce company specializing in logistics for oversized products, marketplace management. Josh, have people got ahead of this? Have they changed their business models?
Yeah, Caroline, I think a lot of folks have. They've known this coming for a while. I think others, though, were pretty stuck in the business model they had built because they really built it around leveraging the de minimis loophole. So I see a lot of businesses who have been doing work to kind of prepare themselves for this, and I see others basically having to shut down their business model, frankly.
Why would you have to shut down a business line? What kind of products or what were they unable to achieve to make it profitable for them?
Yeah, I think it's mostly the smaller sellers. So a lot of smaller sellers they basically have to figure out how to do the paperwork in order to do the customs clearance, and they're just not set up for that scale, as well as they were really competing on the premise that they were able to transact at a much lower price point than the rest of the digital shelf. And so that gave them a competitive advantage to have lower price. And now that they don't have that, they didn't have anything else that was differentiated enough in order to win. And so I think those are the ones who are really at risk here and struggling.
The ones that have made it work, how much have they nearshored, reshored, looked at other countries?
Yeah, you see a lot of that. A lot of our brands have been doing that as well. I'd say our business model, we do a little over $1 billion online, and most of our stuff is not de minimis, but the ones that we work with who do it, they've already been moving a lot of fulfillment onshore. We've been actually helping folks with that, as well as they've been moving to other countries. And I think really the news today shuts down the other country loophole. We already saw the impact of this from China back in May. And so I think the market already had a chance to see how that would play out, and now we're just kind of closing up the other port of entries, and that really forcing that more domestically.
Okay, so have any decided to make domestically, build in America, or are they building in Mexico?
I think there's still a lot of nearshoring with Mexico. I think there's a lot of brands that I talk with that are looking at what they can do domestically, but the labor market is just so expensive that it can be really challenging to do it in a cost-efficient way. I see some brands that are being successful at it, but it's a challenge and it's a multi-year journey. This is not something that can happen overnight. So the real impact here is just raising prices, turning off certain products that are not yet ready. They don't have the sophistication to handle that compliance, to remit the duties, to even get the import bonds. A lot of sellers have never had to deal with that type of complexity. And so I think you see a mixed bag across the board.
So what kind of products, Josh?
Fast fashion is certainly one of the ones that are hit the most, but you see it across the spectrum. De minimis went from, in 2018, just a few $1 billion to over, $60-70 billion in recent years. And you see it across the spectrum. A lot of hard goods sellers as well. But most of it comes from China. And the areas where you really see it as a consumer, you're going to see it on Temu, Shein, areas that were really focused on importing those products through the de minimis loophole and taking advantage of that, as well as Etsy, kind of the custom, unique products that smaller, sellers and creators are selling overseas and then importing to the U.S. You'll also see those products impacted.
Longer term, do you think this will bolster your own infrastructure, e-commerce own infrastructure inside the United States, Josh?
Yeah, we've certainly benefited from it because, mostly because we were not leveraging the de minimis loophole, if you will. We're playing by the rules. And I think almost anybody who was playing by the rules will see the benefit here. They're going to have less folks undercutting them on price because they're not paying the same tariff or duties that we're paying. I also see in the fulfillment structure, we've already seen a lot of brands and companies have worked on building more onshore fulfillment capabilities and moving those products here. So actually, we're also going to benefit from having faster ship speeds because a lot of the de minimis loopholes were slower ship speeds coming over from China and other countries. And now we're going to really pre-position those goods and inventory domestically because there's no advantage to keeping them, in the country of origin, if you will.
Quicker, but maybe a bit more expensive. Josh Kesser, Global CEO of Spreetail. Great to get your expertise. Thanks so much. We welcome our TV and radio audiences worldwide. The US government has begun distributing economic data on public blockchains, marking the latest Trump administration endorsement of the crypto industry. Look, the move creates another avenue for publishing the GDP data, according to the Commerce Department officials. We're here to discuss really the regulatory changes affecting the crypto industry after the crackdown of the Biden years is SEC Commissioner Mark Ueda. We welcome you to Radio and TV. And just recently, Project Crypto was launched, and this really sort of endorses the initiative to modernize regulation to make it fit for purpose for current innovations within decentralized finance. Are we getting enough clarity? How quickly might we know what tokens are securities, for example?
We have a lot of ground to catch up. The last 4 years in the Biden administration, we saw a lot of efforts to suppress crypto, at least in the United States. That was one of the things that the president did, I think it was the third day of his administration, January 23rd, when he issued that executive order with a clear goal. We need to make the United States one of the global leaders in innovation in crypto and digital assets. That was why, one of the things I did immediately upon becoming the acting chairman was to name one of my fellow commissioners, Hester Peirce, who spent an awful lot of time talking to the crypto community. You're going to be in charge of our efforts, leader of our crypto task force, and that now under our new chairman, Paul Atkins, has now pivoted into what we call Project Crypto. We are working side by side with our colleagues at the CFTC. They announced what they call Crypto Sprint. So we're really anxious to get some things done.
In terms of getting things done, there is a sort of fever pitch of innovation going on, and a lot of that is to do with perhaps adoption of new ETFs around things. I'm interested in, for companies, so-called treasury companies that are building up crypto as their assets, or indeed new ETFs springing up. Are you comfortable with the pace of innovation as it is? Are we going as fast or too fast from your perspective?
Well, they are part of the innovation equation, so to speak, but they're just only a part of it. We've got a lot more to do. With these companies, the SEC, in its 90 years of existence, has always been a disclosure-oriented regulator. That means we're not supposed to put our thumb on the scale of whether an investment is good or bad. What our concern is whether or not you're telling the truth when you market and provide the disclosures with respect to these products. So they can put crypto in their treasury. They need to disclose that. They need to disclose the risks about that. They need to disclose what their intentions are as in accordance with our rules and regulations. But there's so much more that we need to do.
Well, important for those companies that are looking to be treasury companies, or those that want to put Solana, for example, or XRP, or even Dogecoin in an ETF. How soon will they know whether those tokens are indeed deemed securities or not?
Well, we've already put out a number of statements from our staff in the Division of Corporation Finance, which says some things are not securities. Now, we are working on, as Chairman Atkins said, as part of his Project Crypto kickoff, to provide some commission-level guidance, what is and is not a security when it comes to crypto. It is tied up in a decades-old Supreme Court decision called Howey, SEC versus Howey, as to whether or not somebody's an investment contract. The good news is that it is what I view as a principles-based test. Is it an investment in money in a common enterprise with the expectation of profits from the efforts of others? How do you apply that in the crypto space? That's what we're looking to do.
In the next month?
Can't talk about timing, but what I can say is this has been part of the Crypto Task Force's efforts from day one of this year. We took a position which I objected to. I put out many dissents objecting to it with this idea that every crypto, with the exception of Bitcoin, which is what our former chairman Gary Gensler testified before Congress, was a security. No, we have this whole framework. We weren't applying it properly. We said, we're going to do this. That was what the Crypto Task Force started doing. That's why they held this series of roundtables. In fact, that was the very first roundtable, was talking about what ought to be in and outside the scope of this.
We're speaking with Mark Ueda, Commissioner for the United States Securities and Exchange Commission. I'm interested in, previously, it was sort of regulation by enforcement, and you said you don't want to put your thumb on the scale in this way. But how many crypto enforcements are ongoing at the moment? Can you tell us in terms of the amount of investigation still going? I know that, for example, Unicoin is being sued, for example, and that happened in May.
We have a number of ongoing investigations and actions related, that I would say are crypto related. We have an awful lot of what one might call fake crypto, which is somebody who purports to be involved in crypto, but it is nothing more than the types of Ponzi schemes and other scams that we have seen since probably the creation of currency.
How many staffers are looking at enforcement now compared to the prior 4 years?
Well, what we've done is we still have a unit, although we've changed it from the cyber and crypto unit to be more broadly focused on technology. We have an enormous number of tips, complaints, and referrals that come into the agency every year. In fact, I think we're on track for nearly 45,000. A number of them relate to crypto, so we deploy staff appropriately.
And you said you're working in lockstep almost with the CFTC. How is that relationship going at the moment?
We've got a great relationship, and it's one of the things that was very important on the financial regulatory front, not only between us and the CFTC, but us with Treasury and the banking regulators about how to address crypto. You saw this with the President's working group on digital assets. They issued the report last month. This has been something that has been, I think, really all of the relevant regulators in the executive branch are all communicating with each other and all coordinating with each other to make sure that we can make this effort successful.
Now, the SEC does more than just look at crypto. And I'm interested in, at the moment, you're currently suing Elon Musk, and that's to do with alleged violation of securities law about when he was taking a significant chunk in Twitter. He had owned about 5% in excess of, and he was meant to make that declaration. Many would say he didn't do it quickly enough. He wants that suit dropped. Should it be dropped?
Well, I'm not going to comment on any particular investigation or enforcement action that we currently have. But what I will say is, we have these Schedule 13D and 13G requirements out there. One of the key parts about whether or not you can file on a 13G is whether or not you are a passive investor. And one of the things that we did take action is there were a large number of very influential asset managers that hold significant chunks, well above 5% of a company's stock. The question is, what sort of relationship should they be having that requires additional disclosure? If they're asking or directing the company that says, you need to do the following things, for instance, on climate change, you need to hit net zero goals, you need to have a plan of how you get to net zero, you're no longer a passive investor. That requires additional disclosures of some form, because we have concerns whenever or at least I should say Congress passed laws telling that when you have really large shareholders, more than 5%, which perhaps doesn't sound a lot, but in the real world, that is quite a bit for a company, that they need to provide the appropriate levels of transparencies of their discussions with company management.
Well, plenty more on your agenda other than just the Elon case and indeed just crypto. It's been wonderful having some time with you. We'll let you get back to the day job. Mark Ueda, of course, Commissioner for the United States Securities and Exchange Commission, the SEC. Meanwhile, President Trump is threatening so-called substantial tariffs on countries that impose digital levies. Just days after we understand that Meta CEO Mark Zuckerberg privately raised concerns during a White House meeting. Sources say that Zuckerberg met with President Trump last week behind closed doors. Let's get more on this with Riley Griffin. Riley, it's interesting that basically lobbying works, it seems.
Yeah, last week we learned from sources that Mark Zuckerberg had come to the White House to talk about many things that have been on the agenda in previous meetings. As you know, Caroline, Mark Zuckerberg has been making frequent trips to the White House since the outset of the year, talking about artificial intelligence, European regulation. What was new here was the discussion about digital service taxes. These are the taxes that are imposed on companies related to their revenue generated from users abroad. And this takes place in France, Italy, Australia, Spain. And the lobbying did indeed work. We saw that Donald Trump, the president, tweeted on Truth Social, about these taxes, threatening tariffs just on Monday.
Riley, tell us the context of the relationship between Mark Zuckerberg and Meta more broadly with the administration now, because it's a very different place than it was in the previous Trump administration.
No doubt. Remember, in the past, Donald Trump had called Mark Zuckerberg a criminal. He threatened to throw him in jail. This was some of the conflict that arose after January 6th when Meta suspended Trump from all of its platforms. Since then, we've seen a rekindling of that relationship that really began in earnest after the president was reelected this past November. Zuckerberg has made frequent trips to Mar-a-Lago, to the White House, and he's donated to the inauguration via Meta. He attended the inauguration, even co-hosted a black tie event in the president's honor. This is an ongoing relationship. We're seeing Zuckerberg actually purchase real estate in D.C. He now owns 2 homes near the Naval Observatory. They are all in. And this is just the latest and greatest conversation that has happened between the two as that relationship continues.
Riley, in terms of impediments on revenue growth, is digital services tax the biggest one on Mark Zuckerberg's agenda when it comes to things that could be changed from an administration's level, or are there other areas that he's concerned about?
Well, remember, Meta itself, it's the parent company that oversees Instagram, it oversees WhatsApp, Facebook. These are products that make the most of their revenue from advertising at users. So these kinds of taxes set a uncomfortable precedent for Meta. European regulation is much more concerning to the company than what we're seeing here in the US, especially with a friendly administration to Silicon Valley. So between the digital service taxes, between other regulations in the EU around speech, Mark Zuckerberg has been quite concerned there. We're also thinking about AI and regulation of AI as the company pivots and really makes that perhaps the top priority of this year as it invests hundreds of billions in infrastructure.
And I think it was President Trump and his cabinet meeting showing the Louisiana data center that Meta is currently building. Bloomberg Tech reporter Riley Griffin, it's so good to catch up with you. Thank you. Now, coming up, we take a look at the state of the secondary markets as investors look to follow Trump policies when it comes to their investments. We speak with Emily Zhang of PitchBook. Meanwhile, let's just check in on some of the big movers of the day of the week. Nvidia, it's been all about their earnings. We're off by 3% now on the day, the worst week since May for the company as we digest competition coming from China, lack of access perhaps into China. But keep an eye on some other areas. Marvel Technology, it makes really specific chips for the likes of Amazon. The likes of Microsoft were off by 16% as they were unable to really give clarity on the future of demand, some lumpiness there. We're seeing Dell Technologies off by 8% as there was perhaps a slight slowdown in bookings for their AI servers. This is Bloomberg Tech. Let's talk about the now not so nascent secondary market for US startup equity. It's shifting as the Trump administration pushes an America First agenda in AI and crypto and defense. PitchBook data shows demand still outweighs supply, investors eager to follow these very themes in terms of investing. Joining us now, Emily Zhang, Senior Venture Capital Research Analyst at PitchBook. Look, many people want to be able to buy shares in these hot startups, and few can, but there is a secondary market. Where are people piling into and how, Emily?
There has been a really big concentration in the top companies, mainly because information is really hard to come by in the secondary market. Venture is already opaque, so if you're looking to invest in venture and you're newer to the space and using secondaries as that tool, you'll look at companies that are getting the most headlines, that are raising the most capital more recently, and that's why we're seeing such a heavy concentration. About over 90% of trading volume on Hive is in the top 20 companies.
And I can imagine that's the OpenAIs of the world, the Anthropics, the Andurils. If you think of crypto names that are still to come out, I think Gemini is looking at some sort of exit. $61 billion in volume. How does that compare to the needs of, say, VC companies that perhaps want to exit certain positions, or indeed the actual workforce of startups who want to be able to sell out and have liquidity on the secondary market?
$61 billion is notable, but for comparison, it's about 2% of primary unicorn valuations, and it's about a third of primary VC exit value over the same time period. So what it means is that secondaries are a vital liquidity valve and have a lot of room to grow, but in its current state, it really only benefits the select employees and investors that have access to these top companies that are driving much of the volume.
What about the volume changing around IPO expectations? There's reports in the Wall Street Journal that as soon as next week, the marketing, once again, of Klarna is going to start. I mean, what will we see in terms of the hype around the secondary market if which company is about to IPO?
So there is a very strong correlation between primary VC exit activity and the secondary market. For example, when space and defense company Voyager went public earlier this year, immediately the secondary market looked at Anduril, which is also a defense company, and they are trading at one of the top 10 companies across multiple platforms. So there is this symbiotic relationship, and that's also because of this pricing transparency. Secondary investors are inherently different than primary venture investors because they have a lot shorter timelines. They don't want to wait 10 years for an exit. That's why they're investing in the secondary market. So as soon as the IPO window opens and there are more activity, then secondary investors will probably likely buy more secondaries.
Who are the secondary investors?
There is a really wide range, but because secondaries have a lower barrier to entry for venture with shorter timelines, like I mentioned earlier, also you're investing in late stage, more mature unicorns that have proven business models. We're looking at more family offices, pensions, more non-traditional investors, most likely. There's also a lot of venture firms that are either creating secondary specific funds, or there are already a lot of established players in the space that look at secondaries as their specific strategies. So there is a wide range of investors in the space.
It is the tale of the haves and the have-nots when it comes to raising money. So is that the case in the secondary market? Are we seeing certain companies in certain sectors totally overlooked?
Yes, so the companies that are really gaining the most attention is correlated with primary VC as well. There are a lot of tailwinds from key policy priorities of the Trump administration, including AI, crypto, fintech, defense, security, and we're really seeing a lot of interest in that space through the secondary market as well.
Lastly, IPOs. Are we going to get a whole spate of them in September, do you think? Is the window going to remain open?
I think the window is slightly open, and it's more of a reset rather than a rebound right now, just because a lot of the companies that we are seeing filing for IPO are aligned with the Trump administration's key sectors, or they are incredibly profitable. Like Figma had a really strong business model and strong fundamentals. So it's the tale of two cities for IPOs right now. You have to be aligned with these key sectors, or you have to have strong fundamentals, profitability, or at least a path towards that.
Emily Zhang, it's great to catch up with you of PitchBook. We appreciate it. It's been a big week, to say the least, for AI investment themes, with earnings from NVIDIA, Marvell, Dell. Investors maybe questioning the pace of the AI infrastructure spend going on right now. Maybe they're questioning Chinese domestic competition. Joining us now to break it down, Bloomberg Intelligence senior analyst Mandeep Singh. Mandeep, let's focus in on what, if anything, Marvell's telling us, because they are all about, chips specifically designed for an Amazon or for one of the hyperscalers. The lumpiness has got people worried about, if you can't win now, when can you? Is this just an idiosyncratic story?
It sounds like they weren't as bullish last night as we heard Jensen, talking about the top 4 hyperscalers spending $600 billion. So I would put Amazon in that top 4. But look, you will have periods of digestion. That's always been the case with data center spend. But the one thing I would call out is Jensen saying data center market will be 3 to 4 trillion. Now, traditionally, that's more like 300 billion. So he's talking that market becoming 10x by the end of the decade. That's huge. If that's true, we're talking about durable growth.
And so therefore, looking at Dell's AI server business and the fact that the amount booked was half of what it was the previous quarter, don't worry about that, because this is going to come in fits and starts.
Exactly, and you have to think through 2030, because that's what he's saying. Every company will spend more on AI infrastructure. The hyperscalers will keep spending on their CapEx because there is so much demand. And look, they're the biggest company out there. They have more visibility into what the supply is, what the demand side is. So if he's saying that, and the use cases are emerging. The next vector I would point out is the cost side. So if Gemini is able to, do a Gen AI use case at a fraction of a cost that OpenAI can, then that will be a durable advantage. And that's where, a company like Google that is vertically integrating with their LLM chips may have an advantage in the long run, if the LLM performance matches at parity.
Quickly, the Chinese giants are vertically integrating as well. Is there a worry for NVIDIA there? Because the stock is down on reports that China's really going at it for domestic chips.
And that too, Alibaba. We're talking about the largest cloud player developing an in-house AI chip. And that's where, all the hyperscalers, if they decide to go in-house, will have a bearing on the semiconductor companies, whether it's NVIDIA, Marvell, or anyone else, Broadcom.
NVIDIA currently having its worst week since May at the moment, off by 3%. Mandeep Singh has been across our network, I think on every single show throughout this week. We wish him a restful weekend watching the tennis. Mandeep Singh of Bloomberg Intelligence. Now that does it for this edition of Bloomberg Tech. Do not forget to check out our podcast. You can find it on the terminal as well as online on Apple, Spotify and iHeart. Wishing you a wonderful Labor Day for those that are going to celebrate on Monday. We've got a day of rest, so big thanks to the team here. This is Bloomberg Tech.